People often will say things like, oh, I get a tax deduction, like I'm purchasing this thing for work.
Yes.
It's not like you're getting the whole thing back.
Yes.
Welcome to the Get Rich Slow Club podcast. I'm Anna, and I'm here today with a special guest. We've got Julian, who is the founder and CEO of Mauro, which is an all-in-one accounting and mortgage broking business designed to help people access supportive advice without judgment. And he's absolutely no stranger to social media, so definitely give him a follow on socials. So before we get into all things about how to plan for the end of the financial year, because that's a very important thing that we all have to do as investors or people who work, what is your money win or loss?
Well, thanks for having me. I was trying to think hard about this one. So I've got one that's a loss and a win, as you do. So the loss is I just found out I need 4 new tires.
Oh my God, me too.
Which is good, right? So that's the loss. And the win, naturally, because I'm an accountant, is a portion of that is tax deductible because the car's used for work purposes. So I'll be out of pocket, but I'll claim a little bit back. So it's a win and a loss. It's more of a loss than a win.
Oh my gosh, that's so good to know because I haven't even thought about that. If you're using your car for work purposes or like a work car, So
get your tires in before in financial year. There's an early hack.
Oh my gosh, because that actually, I literally was having this conversation with my partner this morning because we're also like go to Costco. So Costco has some like tires on sale or whatnot.
Okay,
so maybe that's somewhere to look if you haven't bought them yet. But now a mental note for accounting purposes, we
100%.
can do that. So that's not the only hack that we're going to learn today and that you can include your tires as part of your…
Potentially,
depending on how you're using them.
Yes.
What are some of the most common things that people don't know that they can actually claim when they're doing their taxes?
I suppose a way to backtrack on that is also like looking at what the HO is focusing on, which indirectly tells you what you can and can't do, right? So a lot of the issues with tax deductions are, well, number one, people overclaiming. They're not linked to your actual job, right? And you don't have the proper records for it. So when people come to us or clients come to us, it's a lot about the training of making sure you've got all those records first, right?
So let's talk about those 3. Yeah. Overclaiming, what would fall under that?
Overclaiming would be
category?
something that's partially personal and partially for work. So instead of apportioning it, someone just says 100% of this is work-related, which it's not.
So like if you're working from home and you have the internet.
Correct. They claim 100% of the internet bill versus working out an apportionment of 50-50, 70-30, whatever it is. So there's your kind of overclaiming. Then the not linked to your income or too loosely linked, let's just take a rogue example. And it's kind of like I'm an engineer and I go and do an education course on art. Trying to think of abstract things, right? Yeah. Clearly it's not linked to my job. So that's not a deduction, even though it was a legitimate cost to you.
Right. Okay.
Right. People do some more rogue things than, that, but there's a nice example. And then in terms of the records, so one that we see often is people think that a bank statement is sufficient proof of a purchase, right? And where that falls short is on your bank statement, it might say, hey, I spent $1,000 at Officeworks, and you tell the accountant that was for a laptop, right? But in reality, the bank statement doesn't show what you purchased. You could have purchased a bunch of lollies for all we know.
Yeah,
so you need the receipt to actually back up the statement. The statement shows that you actually incurred the cost, and the receipt shows what was actually purchased.
And that's why what I love doing is taking a photo of it.
Yes.
If they don't have the ability to give you an actual email of your statement, but just like taking a photo, putting it in my phone under a specific folder so that I know at tax time, this is what I did. That's been a good
throw it into
hack.
a Dropbox for small business clients that use like cloud software, but kind of like drop it in there. So many ways these days. So you don't need to have a shoebox of receipts anymore. I don't think anyone really does that, but people talk about it.
Yeah, for sure.
Yeah. But going back to your question around other things that people are probably missing or need to think about, working from home is still a pretty common one in 2026, and the different ways you can claim that. So 2 main methods. One is kind of the easier, one's the harder. So the easier one is you just track your hours, right? And the HO doesn't want you to use estimates anymore. You can't just kind of say 8 hours a day, 5 days a week for the year, right? So they want things like a diary note, or it can be backed up with your roster or a timetable or something of the sort. You need to actually track those hours. And then you claim a rate per hour, so 70 cents an hour, right? And then in addition to that, you can claim separately, any equipment that you purchased or depreciation on equipment, fun, right? Option 1 is kind of your fixed rate.
So you actually have to have a document where you're writing all this down, and that's
You're writing, you're essentially tallying your hours, right? Come to the end of the year, then you get that rate per hour. So that's seen as the easier method. And like you can see, it still requires some kind of record keeping, right? Yeah. Nothing's super easy in tax, but easier. And then you've got the actual method. This is more so for someone that probably works from home a lot, or it's more justifiable for them to do more record keeping. So instead of just claiming a rate, they might work out exactly what percentage of their phone and internet is work-related. So they might track their calls, they might track their usage, and they say, hey, 80% is work-related, so they claim 80% of that bill, right? And then the same with, utilities, equipment, bits and bobs. So it's kind of, seeing where you're at in terms of how much you're working from home, working out which method is best, or even if you do the record keeping and you go to the accountant and you say which one gives a better deduction, that's an option as well.
So would the accountant then do both? Like, do you do both and see
as
what
long as you've got the records that you've done
right.
both. Because if you come to someone and you kind of say, I don't know which one to do, but I haven't actually kept the records of doing the actual method, well, then you're kind of limited to option 1.
Right. Okay. Gotcha.
The accountant can only work with
what they have.
We're like, work with this here. Like, give us some good documents and we'll make it
But do
better.
you think one is better? Like, have you ever done an example where you've done both and you're like, actually, the ATO method, their formula is better versus this?
I think it does come back to how much you work from home. If it's kind of like your basic stuff, a day from home a week, like more often than not, the fixed is more than enough. And then someone that's like, 3+ days from home, a lot of bills, all that kind of stuff, then
it's better.
Makes sense.
Right. I'm taking note.
Do the extra work and it'll be fine. So work from home is still a big one. Another one, if you like. Always thought about, ATO said same thing this year, bit of extra scrutiny. So, keep an eye out, but it's traveling for work. So specifically in your car, right? So number 1, obviously it can't be reimbursed by your employer. That's a given. It works similarly to the work from home. So you don't need to track, you don't need to have your petrol receipts, your insurance, your registration. You're just tracking the kilometers and you're claiming a rate per kilometer.
So this is if I'm driving to the office, not that I'm driving to see a client.
No, the opposite.
Oh, the opposite.
Yeah, the
okay,
opposite. So technically driving from home to the office is considered personal.
Yeah, okay.
Even though you're going to work.
Yeah.
It's always confusing. But then obviously from work, you're going to see a client or you're going to training, you're going to a seminar.
What if you're going to a podcast recording?
I would say yes. Based on us being in a podcast. No, but that makes sense.
Yeah.
So car deductions, I suppose easy again in terms of record keeping is not too difficult and it can add up to a nice deduction.
Yeah.
Other little things that are potentially wins, self-education, right? So it's always a little bit of a win if you are educating yourself and you can also claim that as a tax deduction. So as long as it's linked to, your area and your occupation. Income protection insurance, another one, it's kind of serving a purpose for you and it can be tax deductible as long as you pay it. It's not paid.
I don't think a lot of people know of that
fund.
one, right? Yeah, because it's done in their super, so they're just
correct.
Forget about it.
So if it's paid in your super, then it is what it is. But if you pay it's all or a portion from your bank account, then you can claim that section of it. Union fees, registrations. What we usually say to someone is, we kind of say, here's a checklist. But in addition to that, we say, list down anything that you think was work-related and then go through it with your accountant because you'd rather note it down and them say no than you not bring it forward to the table and it's missed altogether.
Yeah, for sure.
Right.
And people often will say things like, I get a tax deduction, I'm purchasing this thing for work.
Yes.
It's not like you're getting the whole thing back.
Yes. Yeah, I love that one. So that's kind of, we get a lot of, my friend said this, my friend said that.
The big myths.
If I spend $10,000, do I get the $10,000 refund? Like all kinds of crazy stuff. Number 1, you don't get it all back. The way I like to explain it to people in simple terms is our tax rates are between 0 and 45%. So let's just say someone's tax rate is 20%. If you go and spend $1,000 on a tax deduction, the tax benefit is 20% of the $1,000. So you save $200 in tax, right? If you were already getting a refund, it's going to increase your refund by $200. If you had tax to pay, it's going to reduce your tax by $200. So the $1,000 is neither here nor there. It's the tax benefit of it. So when people come to us and they say, hey, I might go buy a new laptop. I might not need a new laptop, but I'm doing it for tax. And I say, okay, well, if you spend $3,000, you save $1,000 on tax, you're still out of pocket $2,000. And if you didn't need that laptop, then it doesn't really make sense. if it's something that benefits you, benefits your business, benefits work, well then naturally it makes sense. You're advancing there and you're getting some tax back. Happy days.
Yeah, for sure.
Yeah. So don't get too excited.
Because I always find that so funny. Just people wanting to spend money because it's like it's a tax write-off without really understanding how much of a tax write-off it
actually
goes back to personal finance. Like, were you going to spend that money anyways? Yes. Or are you just thinking that it's okay to spend that money?
100%. Yeah. So it's the same with businesses, the same with individuals. Businesses get more excited because then they think like there's more stuff that I can just go and buy. But again, if you don't need it, would you buy it otherwise?
So we've talked a little bit about your own individual kind of taxes, what you can claim. If you're a small business, and I've also just started out a little bit on the side, I haven't paid myself yet, but
Congrats,
I do have a small business.
Yeah.
What are some of the things that I should be looking out for?
Yes. So small businesses naturally, I would say, have a lot more flexibility than employees. And a small business by way of nature can be a sole trader, it can be a partnership, a trust, a company. So there's no limitation there as long as you have an ABN. So a couple of main ones when we're doing tax planning with clients is deferring income. Sounds interesting, but let's just say it's June, you've had a really big year, your income's super high, and maybe next year your income's not going to be as high. So instead of doing some work late June and invoicing it, you decide to defer that to the next financial year. One, it might reduce your tax because it's in the lower earning year, or even if it doesn't, it just defers that tax for a whole nother year because you haven't brought it forward. Right, so that's a kind of easy one. Obviously, pending cash flow, like you don't want to not get paid if you need the money. So that goes without saying. On the flip side, it's accruing expenses. So what I mean by that is accounting and tax can be done on an accrued basis, meaning if someone issues you an invoice on the 30th of June, even if you haven't paid that invoice until after, you can still claim it in the financial year. So it could potentially be, making sure that you're invoiced for the goods, the services, whatever it is prior. So you're just getting that tax benefit deduction sooner.
So it's more important the date of the invoice than it is the payment. Mental note, you just reminded me of an invoice I need to send off.
Please send earlier. Prepayments is similar. So prepayments is one where, let's just say you have a lot of monthly costs. You pay for subscriptions, insurances, whatever it may be. You say, hey, why don't I, because I want the tax benefit sooner, I had high income, I want to reduce my tax now. Why don't I prepay a full year in advance instead of doing it monthly?
That's a great tip as well.
Right. So again, as long as cash flow works and all that kind of stuff, you're going to pay it anyway. May as well do it now. Or you've got, costs that are coming up in July and August, bringing them forward and just paying them now versus in a month or two, because that extra month or two means you don't get the tax benefit for a whole nother 12 months.
Yeah, for sure.
Right. Instant asset write-offs, right? Going back to write-offs, businesses have a limit of 20K per year. So any individual piece or any individual asset, I should say, you can claim in full in one financial year versus if it's more than 20K, you need to claim that cost over multiple years, right? So again, don't go rush out and buy things if you don't need them, but you're spending less than that and most equipment pieces are less than that. You get the tax benefit sooner and you don't need to defer it over multiple years.
Right.
Yeah. So there's a few little things to get you thinking.
Those are always good. I think it's even for anyone who's listening who doesn't have a business, you might be doing contracting on the side. You might be doing something else. So it's really important to be aware of that as well, because that's kind of how I think I started. I was doing a couple things outside of my real job, and I was like, oh, how do I navigate this? And then eventually, signed and have a business.
Correct. So it's a bit more formal.
Yeah, a bit more formal, a bit more protection, a bit more separate. But it is. When do you think is a good time for people to kind of set up a little business? I know we're talking about end of year finances, but that might be something that some people are thinking about as well as they're kind of doing something. Do
you mean in terms of they've started something but they want to formalize it a bit?
They're a sole trader and then want to formalize it?
Well, I would say almost the misconception, I might say, is business versus sole trader. So we still consider a sole trader a business, but what people talk about usually is they're kind of should I change from a sole trader to a company? Yeah, sorry, yes, right? To a company. So that's what I meant. That's more so what you meant. I'm obviously not an accountant, no, so this is good because this is the common thing that people ask us, right? They go, I want to set up a business. I'm like, you are a business. They're like, a company. I'm like, okay, different type of business. Yeah. So a couple of reasons. One, unrelated to tax, is the risk and the asset protection. So sometimes someone might not be making any money yet. It's a brand new business. They don't care about tax. But it's a high risk area or they've got personal assets that they want to kind of safeguard a little bit more. So they don't operate in their personal name. They set up a company from day one because it's a separate legal entity. So it's kind of like number one. Number two would probably be if you've got other owners. Naturally, you can't share a business if you're a sole trader. So naturally, you need to go to like a company structure or others. And then tax eventually comes into play. So as an individual, once your combined income sources are above 190,000, that could be your employer plus your sole trader income, then you're taxed at 45% in each dollar, which sounds great. Versus a company structure, for example, it's 25% on the retained earnings in the company. So especially for people that are growing businesses, they're reinvesting the income, they're not actually taking that income out personally. It means you don't have to fork out that extra 20%, so you can reinvest more, grow the business quicker. So that's probably another huge one as well once the income's ticking over.
Yeah. So a big one is also just that distribution of like the income that would come in where it would stay in the business versus if you're a sole trader. That
regardless of if you take it out or not, you're taxed on it.
Yeah, exactly.
Which is where people get caught out because they say, oh, I made 100 grand, I didn't actually take it out. They say, sorry, that's not how a sole trader works. It goes into your name regardless of what you take.
Yeah, I think that's a great tip, especially for people who are kind of doing a side hustle or something. They want to start a business and they just don't know when they should have a company.
For sure. And I think it's a reminder as well, when people have a sole trader, what you take out of the business is kind of irrelevant. So people will say, hey, I made 50 grand and I paid myself 30. That's not how it works. The whole 50 is yours regardless of kind of what you took out.
Yeah, and especially if you're in a higher tax bracket and then all of a sudden you have more money, you could easily be paying 45%,
yeah. Plus your Medicare 2%. So 47% is a big number. Yeah.
So most of us have a super. Are there any tax planning that we should be doing for end of financial year when it comes to super?
Yeah. So applicable for both individuals and business owners are your concessional contributions. So in short, you can claim a tax deduction for your super, right? This financial year, $30,000 is the annual limit. So let's just say two scenarios. One, you've got an employer and let's say they put aside $10,000 into your super already. So you've got a $20,000 kind of shortfall that you could additionally put in if you had that sole trader income and maybe you wanted to offset it, right? So you can claim that in full. The kind of conditions are that one, you've got obviously the fund's got to hit your super fund before 30th of June. That doesn't mean that you put the funds in on like the 28th or the 29th. They actually suggest you do it kind of like early to mid-June. It takes a while to process. And then you complete a notice of intent to claim form. It's simply just saying, I elect this $20,000 to be claimed as a tax deduction. And then us as the accountants see that from the ATO. We put it into your account, into your tax return, I should say. As a self-employed person, obviously your employer hasn't put anything in, so you can use the full $30,000 cap. Only other thing to note with the caps there's a fancy rule that's a 5-year carryback rule, meaning whatever you haven't maximized in the last 5 years, right, you can also put that in one lump sum. So let's just say the year before the cap was 27.5 and you only used 10,000 of that. You can also put in the extra 17.5. So there's a lot of numbers very quickly, but in short, it just means there's huge opportunity for the person that does have the cash flow and wants to put into super and have it benefit them on tax, that there's the option open for them there.
Yeah, so this makes a lot of sense for people who might potentially want to put money in towards their first home super saver scheme because that's within your super. Also people who have maybe a higher
tax bracket.
They want to reduce some of their taxable income. And I think the other thing that maybe you didn't specifically mention, but with those concessional contributions, you can do that through salary sacrifice as well.
Correct.
So you can essentially it's a voluntary contribution without all of these crazy words that we're throwing around. But essentially you are putting that money in and either you can do it asking your employer to do it through a salary sacrifice where you would get that tax benefit, or you do it as a non-concessional contribution, meaning you got paid into your bank account, you're putting it into your super, and then you have to fill out the notice of intent.
100% all over it. And I think when you're a sole trader as well, when I talk to new sole traders, when you work for someone, naturally you kind of think your super is being sorted, and it is to some extent. When you're self-employed, you're so caught up in the business. And then when they step back, they say, hey, I don't actually put money into my super, regardless of the tax benefit, it's not growing, right? And obviously it's not your only investment, but some people just start to think, hey, shit, should I put the money in there? Another question is kind of how much should you put in there? And I don't have the answer to that, but we see people do all different types of things. So sometimes people will look at if they were working for an employer earning that same money that they're earning as a business, what would they be getting in super? So for example, 12% as an employee. So they use that as a base. Other people refer to kind of like it's a cash flow thing. So once they've, split all their money at the end of a month, what do they have left? Other people have financial strategies and all that kind of stuff. So there's many different ways to tackle it. There's no one way fits all.
Yeah,
naturally.
The personal finance is personal, right? Like it depends on your situation.
Yeah.
So this is why it's so important to talk to a tax accountant to help you kind of sort out your stuff. Especially like don't wait till the end of June when you've already done things. It's good to regularly chat with someone. When do you think is the best time to talk to an accountant?
Probably now.
Yeah.
No. So look, we funnily do tax all year round. So part of tax is just lodging the tax returns and the rest is planning. Right. So naturally, after 30 June, you're quite limited to what you can and can't claim. You can't go spend extra money. You can't backdate super. You can't restructure your business. So all those things, the sooner the better.
Yeah, for sure.
Yeah.
And sometimes I think it's like good to talk to an accountant when you're thinking of a new strategy.
For sure.
Like one of the things that I reached out to my accountant was debt recycling, for example. Like not that we need to talk about that or dive deep into it, but again, there's a lot
Just came to mind.
A lot of tax implications based on that strategy. So if there's specific strategies, if you're thinking about your super, if you're thinking about what you're anticipating that you're going to be making a lot of money. Like another great mistake that I made, which I love sharing, is that the year before I went on parental leave, I was putting money into my super for First Home Super Saver.
Yep.
I also was in the I sold a bunch of shares.
Yes.
I got dinged with good old Div 293.
Yes.
Had no clue that was like the first and only time. And didn't get any of my paid parental leave because I was over the cap at the time. So I know that's an extreme example, but it's something that can catch people off guard.
Well, it's like you don't know what you don't know. So all these things are happening, and unless you speak to someone, they're not going to get flagged until it's too late and you haven't planned for it. And I see the same with kind of like business owners. So if you only talk to your accountant once a year and you've started your sole trader business and then it comes around to June and we look at your books and we're kind of like, made a lot of money versus, if you came to a bit earlier and then the accountant actually says, hey, let's look at restructuring this earlier. Let's change to that company structure that we spoke about because it's going to save you on tax. You can do all those things a little bit earlier.
So can you do that within like the middle of the year?
Yeah. Well, people set up companies every day.
Yeah.
Do you know
So for example, if you're a sole trader and you're like, oh man, this new contract is coming. Yeah, it's going great. I'm going to quit my job, whatevs. That might be a really good time to talk to an accountant and be like, oh, let's set up this company so that you don't get dinged by your job, your income that you're getting
when it's all combined. So essentially how that would work is everything up to the company date would go into your personal tax return as a sole trader, and everything moving forward would go into the company at the company tax rate. Yeah. Which is a win if the income's going up and up.
So in the example that I provided, which was the 1 year that I had crazy income because I sold a bunch of shares and whatnot, what is something that I could have done in that situation? So obviously higher income at the time. I thought, hey, I'm going to put some money into my super. I sold some shares. I wasn't thinking. Is there anything, or you're just like, hey, you know what? Good on you. You made a lot of money that year.
Too much money. Donate a little bit.
Yeah.
Look, the super thing wasn't the worst part, but it would just be depending on how close you were to the threshold. So if you just went over the threshold, it would be annoying because you could have brought forward some expenses and got below it. If someone was like, hey, $50,000 over the threshold, they're probably not going to be able to find $50,000 worth of deductions to bring them back below the limit.
Does that bring forward rule happen like only once in your lifetime? Like
No. It's like a rolling 5 years.
Oh, it's a rolling 5 years that you can do. Okay,
correct.
Great. That was a silly question that I never really thought about. But
answered your own question.
Yeah, but you know, like you said, I haven't properly used that. So it's just like something I was like,
There's
wait
a
a second.
feature on the ATO. We see it on our tax agent portal, but I presume you'd see it on MyGov, and it kind of shows you your running 5-year balance or total that's available. So refer to that. But it would have been potentially, hey, do we defer some of these share sales or into the next year when the income's lower? Do we bring forward some deductions? Do we put in some more concessional super? Whatever it may be. But
yeah, there's a lot of learnings in that situation, and a big part was I was leaving a job that had that had equity in it, so I had to sell it out at that time, or I couldn't. I know some people who listen to the podcast are in a sometimes they work in a startup and they do have some equity and then they leave and they have to kind of choose that.
And it comes in the financial year that it does.
So sometimes you're kind of stuck with what you have. Again, at the end of the day, grateful that my taxes give me roads and hospitals.
Yes.
So
as we all are.
we're not going to complain about that. But if there's ways to minimize it, it's always like a great thing to do that. And I think back to your point, talking to an accountant, if you know that you're working in a company where you might be able to have shares that you can sell off at a specific time. Not being stuck the way I was, where it's like, it's now or never. I'm going to lose them if I don't. Being able to kind of properly talk to someone and have a plan is also very beneficial.
100%. Saves you money. Another example I just thought of, which is not that, but it comes back to why you should talk to someone sooner rather than later, is the funny old GST, right? So GST is for business owners, generally once you're earning over 75K. So we'll have a lot of examples where people are late on their taxes, or once again, they come to us once a year. And then at work, turns out that they've gone over that threshold 12 months ago, 18 months ago. The ATO isn't that lenient. They don't say, hey, you just need to register for GST from today onwards. They say, hey, you need to backdate it to when, you should have started paying GST. Then all of a sudden, you're now paying back this GST for 12 months or so, and you didn't have the ability then to on-charge it to your clients because you weren't registered. So again, there's just so much in small business that you don't know what you don't know.
So what should you do in that situation?
In
Talk to an
of,
accountant.
So in terms of if you've figured out that you've gone over the threshold, there's no real choices to delay it. Obviously, the sooner you get registered, get it backdated, work out what you owe. Obviously, your accountant can ensure that you reduce it as much as possible because you can claim the GST credits on your expenses. So it brings it down a little bit. And then, unfortunately, whatever you're left with, there's payment plan options with the ATO. You do all that fun stuff. But I think it just highlights the sooner the better, and, just flagging things, even if you're not sure or you sound stupid. And you're kind of like, a lot of people email us and they're like, look, this sounds so stupid. And it's like a 1-minute response and gives them peace of mind. So it's just doing that.
Yeah, because sometimes it's so easy to accidentally say something wrong or think something the wrong thing. And it's just better to check that because it can really impact you in the future, right? Like we're talking about taxes here. This is money in your pocket.
100%. And I think a lot of our clients, they've kind of learned that some accountants can be super daunting and, it's very corporate and whatnot. So align yourself with someone where you don't feel bad to say the stupid question and actually educate yourself as you go.
So the new financial year is around the corner, the 26-27 year. What are some things?
Sounds crazy, doesn't it?
I know, it's wild. I feel like we're
Did
in
you know
the
the due date for 26-27 is 15th of May 2028? So we're talking to people at the moment, and like after the 1st of July, the next financial year, that becomes due in 2028. So we're living years ahead.
It's wild. It is, when you think of it that way. And no one really wants to do too much future planning, but it is important to think about the next financial year. What are some things that people should be thinking about now for next year?
So I think a lot of the stuff we've touched on will still be applicable moving forward. So that's a good thing to some extent because you don't need to constantly relearn. You just need to stay up to date with things. Next year, they're introducing, so don't do it on this year's tax return, do it on next year's. There's a minimum $1,000 kind of tax deduction without receipts. So at the moment, there's a $300 limit per year that you can claim. And going back on that, because that's a little bit of a hack/mistake that people make, $300 without receipts is $300 in total for the year, not $300 per item. So someone says, hey, I bought 10 things for $299. Can I claim them all? Obviously, no, it's one thing under $300 without receipts. So that's getting increased to $1,000, I suppose, to get rid of a bit of complexity.
So do people just claim that without even thinking about anything?
Well, yes and no, because people want to claim more than that, funnily enough.
Yeah.
Right. So, and more often than not, you might have legitimate expenses that are more. It's just knowing what you can and can't and what records you need to prove. But for a simple taxpayer that might just have, little expenses because everything's covered or there's none, then $300 is nice. Right. Sure. So that kicks into play. Another one, which is not really tax, but it's tax related, is the changes to super from the 1st of July, so the super payday. So as an employee, what it means for you is every single time your payroll is made, your super gets paid directly to your super fund instead of being done monthly or quarterly. So I suppose it's just a little bit of a win to know that there's less chance that your super won't be paid.
Yeah, please check your pay slips. This is really important.
Not even your pay slips, check your super fund.
Yeah, actually,
because that's the definitive, right?
Check both and make sure that they're...
it's actually going in.
Yeah.
I think, people see it on the pay slip and they presume everything's been done correctly, but sometimes it's not actually paid.
I think this is a great change. I'm happy to see this.
For sure. That's your employee side. And then as an employer, it's just kind of like, well, one, making sure your systems are up to date to now deal with the payday. Obviously, cash flow wise, you just need to know that super comes out. So you're planning for it versus doing it quarterly or monthly. But I think it helps because cash flow for small businesses, when you come to an end of a quarter and all of a sudden you need to pay, $10,000 versus paying it in increments, it's probably harder to swallow anyway.
Yeah, for sure.
Right. So that's super. Obviously, budget, which we haven't touched on, and it's probably not worth it yet because there's too many things that are still kind of like...
But lots of people are worried. I'm sure you're getting tons of questions.
Yeah, it was a panic session down after that. So I think a lot of our general advice is we're working from what we've been told. It's kind of like these are some potential strategies, but to kind of wait off until it's legislated. So I think the term that they were using is kind of like panic restructure. So people with trusts all of a sudden are kind of like making these panic decisions, changing their structure. And it might work out for the better, but obviously it might be better until it's all, fully legislated, the details all there, and then you make the best decisions.
So are you seeing people making changes now?
None of my clients, but I had a guy that I knew, and he's like, I just needed to do this straight away. I've gone off and I've changed this. And I was like, we haven't even got the details, but I think he was just panicked.
Yeah, of course, because people have a strategy and then all of a sudden the budget has kind of thrown things in the air.
Throwing the strategy off. Yeah.
And we saw the same thing last year with super, right? With the 3 million super, people were like freaking out. What are we going to do? And then a lot of that kind of got worked out.
Correct. So
don't freak out is what we're saying.
Don't freak out. Watch your space. Like the trust stuff, which more applicable for kind of like your small business clients, that doesn't necessarily kick in until July 2028. Right, hence the why are we rushing legislation? You've got another kind of couple of years. So otherwise, I think all the things we said still pretty applicable. Small businesses, like use the time at tax to not just work out your tax, minimize it, but review your systems, review how you do bookkeeping. Are you still using spreadsheets? Are you spending too much time? Are you making errors? All that kind of stuff, and start the new year fresh. Right, so. I'm just going to have a guess. Do you use like a PDF system? Do you use Excel for tracking your small business?
Yeah, this is a great question. I use Google Sheets has been my thing. So I'm just trying to keep on top of it every month because I'm super small business. Like I said, I haven't paid myself.
Correct,
So I'm just trying to stay on top of it, but also keep my costs low until...
For sure. And that's the thing. It's kind of the mix between the cost of more subscriptions and all that kind of jazz and compliance and making things, easier and harder. So eventually it might get to the point where you employ someone. Naturally, you need a bookkeeping system or an online system, or you want to start doing some reporting a lot easier than a Google Sheet can do. That's another reason. We see people make more mistakes. I'm sure your stuff is great. But naturally with an Excel sheet, it's dependent on you putting in the right numbers, not missing days, all of that. Whereas, all these online accounting systems, it brings in everything automatically and you can't make a typo.
Yeah.
So again, have those conversations or review that stuff at tax time because it makes the tax planning easier as well because you've got that constant data to look at monthly. Your accountant can look at it, you can look at it, your team can look at it, whatever, versus, the scramble.
Yeah, versus my random little Google sheet.
Look,
but
everyone starts somewhere. I've seen a few. I've seen some that are very elaborate and I'm like, it probably takes you longer to do that than an accounting system. So your time is also worth something.
Yeah. One of the things we didn't discuss at all is what you should do about your investments. So a big common misconception is, hey, I started investing.
Yep.
My dividends are being reinvested.
Yes.
I don't have to pay tax on them. Not true. Not
Correct.
true at all.
Not true at all.
So what are some of the things that you should consider if you are investing?
Yeah. Well, that was a good one that you started with. So income is income, regardless of if it's paid to your bank account or reinvested. So without not knowing what you don't know, I suppose flagging in your head that all income needs to be included in your tax return. If you sold shares or units and things like that, the ATO usually picks up on it. So I wouldn't rely on that. But as accountants, we usually get a report and it says, XYZ client disposed of these shares, right? But if you do your tax return too early, it might not be on the report. So I suppose it's on you to flag that to your accountant. Naturally, we're then going to want to know all of your purchase details, dates, amounts, number of shares that come towards the total sale and working out the ultimate gain, right? So record keeping comes into play. Again, people do all kinds of things. Some people are super neat and tidy. Some people don't know. So I think it's just kind of getting into the rhythm of when you do sell, working out the purchases, and then we can do the rest for you.
So here's the funny thing. I've only ever sold the company shares that I had.
Yes.
I've always been like buy and hold.
In that fun year.
Yeah. In that fun year for sure.
Yeah.
So I've actually never sold anything. It just dawned on me that how am I going to navigate this? Like how do you, I mean, obviously there's potential budget changes.
Correct.
But if you're dollar cost averaging in and you are now selling that specific ETF that you've been investing for a long time.
Yeah.
How do you decide whether it was the one you did 10 years ago or the one that you just
10 years ago is kind of, it's gone, isn't it? But I think the benefit of that scenario would be that you haven't sold it so you can plan for it versus someone that sells it because they're either forced to or they weren't educated in the decision. So essentially it could be, hey, thinking of selling some shares potentially for cash flow or diversifying or whatever it is, and then working through the process of, this was the cost base, this is what they're worth, this is what they might sell for, whether there's any discounts and all that jazz, and then working out what your income was in that financial year, like we said, because if you have a low earning year, then it might make sense to have that gain added on top, lower tax bracket, et cetera. Or if you had a high income earning year, maybe it's like, hey, do I not do this straight away? So I think people are pulled into certain scenarios based on, if they need to sell them or not, but it's a great scenario when you haven't sold them yet and you can plan your accountant with your advisor on what that looks like. So then ultimately, I'm not just getting $10,000 proceeds. I've got to deduct the tax first, and this is my real life number. Yeah,
because I think that's the other thing. People forget the tax on top of that.
Yeah.
And then especially if your income fluctuates, if you have a small business, if it might be something else. So does that work then on the cost base that you purchased it at? Can you choose whether it was the one that you purchased 10 years ago versus the one that you...
No, sorry, it was one of the initial questions. So it'd be like first in, first out.
Oh, is that how it works?
Yeah, correct. Okay. Yeah, generally speaking. What was I going to say? Let me off. No, we're good. It'll come to me. The other thing, I had something in there.
No worries. I never really thought about that because it's like, I've been dollar cost averaging in for so long. And I was like, I've never really... I'm in the accumulation phase. I haven't really thought about...
You're not interested in selling.
Yeah, I'm not interested. Buy and hold, I'm okay. Just the company shares, I need to get rid of that ding to me. But besides that...
Yeah, I think, keep your records, continue doing what you're doing, like have it all there, and then you can work through your methods and your final gains when it comes to it.
One of the big benefits is I see that the ATO does pre-fill a lot of that. So anyone who's listening and who's freaked out, yes, collect all your information, but just double check because the ATO may have a lot of that information for you as well.
Yeah, they generally have the sale details from what we see, always the sales stuff. The buys is the info they don't usually have. And if they have it, maybe it's hidden, but they don't show it to us. So we'll flag with someone, hey, looks like you sold X, Y, Z, but we can't see the purchases.
Right. But you see the dividends as well. Like you
dividends,
see
yes, correct. Yeah. More so share sales that are kind of half the equation that they show us.
Right.
Crypto is a whole other kettle of fish. The ATO doesn't go into detail on it in terms of like these are all your gains and losses because that would be crazy. But it does flag to us your client may have disposed of cryptocurrency in a financial year. And it's not always correct. They could just have crypto, have a portfolio, and that gets somehow data matched to the ATO. And you didn't sell anything, in which case there are no tax implications. But if you did, obviously that's, the red flag that the ATO is they do know it exists. So
you can't lie. You can't hide your crypto.
Can't hide eventually they'll catch you.
Yeah, the ATO knows everything.
Yeah. They love this conversation. They're like, yes, we do.
Yeah.
It's like with the work deductions. Each year the ATO says naturally their data matching is getting better and better. And I don't have a guy that I can call the ATO and say, hey, how are you doing this? Because I still don't personally understand how you can data match someone's expenses, right? So they can benchmark expenses, and they've been doing that for a long time. So what they would do is they look at your occupation, your salary, and you'd get benchmarked with other taxpayers to see what, average expenses are. And then if yours are super high, that might flag an audit or a review. And then in the case of an audit or a review, which we haven't touched on, then the ATO could request, hey, we want every single receipt for every expense that you've claimed. And then if it's not there, they can, one, obviously remove it, make you pay the extra tax. And in some circumstances, they can charge interest or penalties if they feel like they want to as well.
How often does that happen?
Look, pretty rare. Maybe my clients are great.
Yeah, I was going to
Maybe
say
we
it's
give them
because you have
education.
good clients.
But look, your accountant, a red flag actually for your accountant is if they accept everything that you give to them, they don't ask any questions, they don't even prompt you to say, ensure you have receipts, and they just put it all in, probably not ideal, because I think there's also the false conception that it falls back on the accountant, right? And they're kind of like, oh, well, the accountant did it, like, I'm fine.
But they're not on the hook for it.
Yeah, well, naturally you sign a
Yeah.
declaration on your tax return saying, I've got receipts, I've got substantiation. So yeah, it's gonna fall back on you anyway. So make sure you're talking to someone that's giving you good guidance, not just
I think that's a great
go nuts.
tip. If your accountant says nothing and just files it off for you.
It seems fun, and you're probably like, this guy's great.
Yeah,
but
they might.
I think you
not
think past that after a little while, and you're kind of like, I'd rather sleep at night. Yeah, maximize tax where I can.
I'd rather someone question me and be like,
Yeah.
it looks like $2,000 on, XYZ. Are you sure?
Luxury handbag.
Yeah,
That's a good one.
yeah. Do you get luxury handbags?
As questions?
Yeah.
All the time. Yeah.
Yeah.
We work with a lot of kind of like UGC creators, influencers, people in social media. So the questions you get can be more rogue because naturally the lines between what's personal and what's work-related harder and harder to kind of see. So they're valid questions because yes, you might wear that bag in content, but was it required? Did anyone tell you to buy it? Is it in a contract? Did you need it to earn the income? All these questions, the answer is probably no all the time. So generally you're not claiming, $3,000 Louis bag or whatever it is.
Right. But if you're buying lighting, cameras,
fun stuff,
microphones that you kind of need to create content,
yes,
you can claim those.
100%.
Yeah.
You're like, give us something.
Meanwhile, I've got my old beat up backpack.
Yeah, you can upgrade that.
For sure.
Just be mindful.
Julian, it's been such a pleasure. So many great tips here. I know that I'm going to just be a bit better at my accounting because you've reminded me of a couple things I need to double check.
Amazing.
You've got so many great tips on social media as well. Where can people find you if they want you as an accountant or just want to get great tips off of your social presence?
Social media handle mauro.au. And we're super flexible. So send us a DM, do a form on the website, send us an email, and happy to help. Thanks for having me. It's been fun.
Awesome. Thank you so much.
Awesome.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Anna Christina. The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invests and Anna Christina from Perler. Knowledge is power, especially when it comes to investing, so make sure to check out our financial services guide and read the product disclosure statements and target market determination for any investments you're considering. See our show notes for more info. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you. This show was brought to you by Natasha Etchman, who is a corporate authorized representative, number 1317713 of Rask Licensing Proprietary Limited, and Perler, who's an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on, from coast to coast across land, waters, and communities. We pay our respect to elders past, present, and emerging.